I need to stop you right there. Look at your screen. Look at the number sitting next to the silver ticker. If you're watching from New York, from Chicago, from anywhere in North America, you're probably seeing something around $71. And if you're a technical trader, you're drawing your support lines, you're mapping out your consolidation patterns, you're telling yourself the market is holding steady. But I'm here to tell you that number is a fiction. It's not just slightly off. It's not just a temporary anomaly. That $71 price is a ghost signal from a dying system that hasn't realized it's already flatlined. Because right now, on the other side of the Pacific, in the streets of Tokyo, physical silver bars are changing hands for 20,000 yen. Let's do the math together. At current exchange rates, that's roughly $130 per ounce. Now look back at your screen. $71. That's a $59 spread. That's an 83% premium over the so-called global benchmark price. I want you to understand what this means. An 83% divergence between paper price and physical reality is not a market inefficiency. It's a market failure. It's a complete systemic fracture. When you see a 2% spread, that's normal dealer markup. 5%, that's high demand. 10%, that's a supply squeeze starting to show stress. But 83%, that's the financial equivalent of cardiac arrest. It means the mechanism connecting the paper market to the physical market has snapped. The cable's been cut, and the people who built this system are scrambling to hide the carnage before you notice. Now, I know what the skeptics are going to say. Japan has consumption taxes. They have fabrication costs. You can't compare a 1,000-ounce commercial bar in a New York vault to a 1-ounce retail coin in Tokyo. And to those people, I say you're missing the forest for the trees. Yes, there's friction. Yes, there are costs. But friction doesn't cost $59 an ounce. It doesn't cost $59 to stamp a piece of silver or ship it across the Pacific. Even if you added up every tax, every insurance fee, every minting cost, you might get to $10, maybe $15. Where's the other $45 coming from? It's coming from panic. It's coming from scarcity. It's coming from the fact that Japanese citizens are watching their currency implode and they're rushing for the exits into hard assets at any price. They don't care what COMEX says the price should be. They know that if they try to buy at $71, there's no metal available. The spot price is the price of a contract that settles in cash. The street price is the price of survival. And right now, survival costs $130. This divergence proves something critical. The arbitrage is dead. In a healthy market, the banks, the big players, they act as equalizers. If silver is 71 in New York and 130 in Tokyo, a bank like JP Morgan should be backing up the truck. They should be buying every single ounce on COMEX for 71, chartering cargo planes, flying that metal to Tokyo, and selling it for 130. Even with all the costs, they'd make $30 or $40 per ounce risk-free profit. On 1 million ounces, that's $30 million of free money. Banks don't leave $30 million on the table. They'd kill for that kind of return. So why aren't they doing it? Why is the gap sitting there wide open? Because they can't. The plumbing is clogged. The logistical chain connecting the industrial bar in a New York vault to the retail market in Asia is broken. There isn't enough refining capacity to melt down big bars and turn them into small bars fast enough. And most importantly, the supply in New York is not as liquid as they pretend it is. If a bank tried to withdraw 10 million ounces from COMEX today to ship to Japan, they'd trigger a default. The exchange would stop them. They'd force cash settlement. So the arbitrage trade is impossible. The banks are trapped in the paper world. The retail buyers are trapped in the physical world. And the bridge between them is burning. This is what we call bifurcation, the splitting of reality into two distinct markets. In reality A, the paper world, silver is cheap, abundant, tradable with a click. The chart looks manageable. The price is 71. In reality B, the physical world, silver is rare, disappearing, requiring 6-week delivery times and massive premiums. The price is 130. You have to decide which reality you live in. Now let me be very clear about something. The internet is on fire right now with people screaming that the banks are dead. That JP Morgan is short silver at 71, but the price is 130, so they're insolvent. The collapse is happening tomorrow. I'm here to tell you it's not that simple. Yes, the banks are hurting. Yes, they're bleeding. But if you think a bank with $300 billion in Tier 1 capital is going to collapse because of a few billion in silver losses, you're underestimating your enemy. Let's look at the actual math. Open the latest Commitments of Traders report from the CFTC. The commercials, the polite name for the bullion banks, are currently holding a net short position of roughly 40,000 contracts. One contract is 5,000 ounces. 40,000 times 5,000 is 200 million ounces. If silver moves from 71 to 100, that's a $29 loss per ounce. 29 times 200 million is $5.8 billion in mark-to-market losses. In the real world, if a hedge fund lost $6 billion overnight, they'd be liquidated. But here's the uncomfortable truth. $6 billion is a rounding error for JP Morgan. They have $300 billion in Tier 1 capital. The silver loss represents maybe 2% of their safety buffer. Does it hurt? Absolutely. Does it ruin their quarterly earnings? Yes. Will shareholders be furious? Without question. But does it bankrupt the institution? No. It's like getting a flat tire on your car. Annoying, costly. But you don't abandon the car on the side of the road. You have a spare tire. You have insurance. The bullion banks have the ultimate insurance policy. It's called the Federal Reserve. And there's another layer most people miss. That 40,000 contract short position isn't necessarily naked exposure. Banks are bookies. They balance their books. While they're short 200 million ounces on COMEX, they're likely long hundreds of millions in the over-the-counter market through forward contracts with miners. A Mexican silver miner wants to lock in a price. They call JP Morgan and sell them 10 million ounces at $70. JP Morgan goes to COMEX and shorts 10 million ounces. Now they're neutral. If price goes up, they lose on the COMEX short but gain on the miner contract. The two cancel out. So when I hear people saying the banks are finished, I have to pump the brakes. They're wounded. They're bleeding liquidity. But they're not dead. This is a painful deleveraging, not a bankruptcy event. They're slowly covering their shorts, eating the losses, stepping back from the suppression game because at $71 with shortages looming, suppression has become too expensive. They're managing a controlled retreat, and wounded animals are the most dangerous. But here's where it gets interesting. While the banks can survive, their survival mechanism is exactly what clears the path for silver to rise. They're no longer the wall-blocking price. They're becoming the speed bump. And why has suppression become so dangerous for them? Because of the physical variable, the one thing they cannot hedge, cannot print, cannot regulate away, the supply shock. Let me walk you through what just happened. Today is January 1st, 2026. As of this morning, new Chinese export regulations on strategic metals are officially active law. The media calls it export licensing, soft language. But licensing is bureaucratic code for soft ban. Under these rules, only mega refiners, the massive state-owned enterprises reporting directly to Beijing, can export silver. The hundreds of smaller private refineries, the scrap recyclers, the trading houses that used to flood the global market, they're cut off. They can't get licenses, they're forced to sell domestically. And will the mega refiners export? Technically they can. Practically they won't. Their mandate has changed. For 20 years, their job was profit. Refine and sell to whoever paid most. Today, their mandate is strategic security. Ensure the Chinese solar industry, the EV sector, the military complex have first access to every ounce produced within China. They'll only export if there's surplus, and here's the terrifying reality. There is no surplus. China produces roughly 3,500 metric tons annually, but their industrial machine, the beast producing 80% of the world's solar panels, consumes over 6,000 tons. That's a deficit of 2,500 tons. They're running short domestically. Exporting silver now, from Beijing's perspective, is an act of strategic negligence. So the wall is real. It's not concrete. It's regulatory. And Western buyers who relied on steady flows of Chinese silver are waking up today to a dial tone. This creates a permanent structural deficit for the West. The United States doesn't mine enough silver to meet demand. Neither does Europe. We're deficit regions. We rely on imports from Mexico, Peru, and China. Take China out, you remove one leg of the stool falls over. The West now has to fight over remaining supply from Mexico and Peru, which means premiums have to rise permanently to attract metal. This isn't a temporary squeeze. This is rewiring of global metal flows. And this is where industrial panic moves from slow burn to wildfire. Think about the second-tier companies: medical device manufacturers, 5G infrastructure builders, defense contractors. They don't have the political connections of Tesla or the balance sheet of Apple. They relied on the open spot market, clicking a button and buying silver at London Fix plus 10%. That world died today. Now they're staring at a market where spot is 71, but China price is 110 and Japan price is 130. They're seeing global inventory getting sucked into an Asian black hole. This creates a psychological shift called inventory hoarding. When a critical component becomes scarce, companies stop ordering just in time and start ordering just in case. They overorder. If they need 10,000 ounces for February, they order 20,000 for safety. Because having too much silver costs storage fees. Having no silver costs factory shutdown. This behavior amplifies shortage, creates a self-fulfilling prophecy. As soon as one company hoards, everyone must hoard or be left with nothing. The phantom demand is rising. Orders are being placed not for consumption, but for safety. And this phantom demand is hitting a market that just lost its biggest supplier. This is the real trigger. Banks can manipulate paper price on COMEX because it's a closed loop of digital contracts, but they cannot manipulate the fact that a factory in Ohio needs physical silver for a missile guidance system, and that silver is sitting in a Shanghai vault that just locked its doors. For the first time in history, Western financial elites are powerless against physical reality. They can print dollars to bail out shorts, but those dollars are useless if there's nothing to buy. What good is $1 billion if the seller says not for sale? Now let's talk about what's left in the vault. According to the latest warehouse stock report, total registered silver in COMEX system has fallen to 38 million ounces. To the average person, that sounds like a lot. But look through the lens of global markets. The world consumes roughly 1.1 billion ounces annually. That's about 3 million per day. 38 million divided by 3 million, 12 days. The global benchmark for silver pricing is sitting on less than 2 weeks of supply. But it's worse than that headline suggests. Banks play a shell game with inventory data. They point to total inventory of 270 million ounces and say there's plenty. But inside that number are two categories, registered and eligible. Registered is available for delivery. That's the 38 million. Eligible is metal sitting in the vault that meets purity standards but belongs to private investors who aren't selling. The banks can't touch it without owner permission. And if you own silver in a COMEX vault seeing Japan price at 130, are you selling for 71? No. You're holding or withdrawing. So eligible is frozen. The only liquidity is that shrinking pile of 38 million in registered. This is Gresham's law in action. Bad money drives out good. When a commodity is priced artificially low, the market drains physical supply until nothing's left. COMEX is essentially a store selling silver for 71 when the world values it at 100 plus. Smart money, arbitrageurs, industrial buyers, sovereign funds are standing for delivery because it's the cheapest place on earth to buy metal. They're looting the vault legally. Every time banks smash price to 71 to save their shorts, they ring the dinner bell for physical buyers. Withdrawals are accelerating. And here's the terrifying part. The refill mechanism is broken. In the past, when registered got this low, price would rise and metal would flow in from London or China. But China is closed. Eligible holders aren't selling at 71. They're waiting for triple digits. The drain is one way. It's a bathtub with drain open and faucet off. Mathematical certainty the water hits zero. So what happens at zero? The exchange will likely suspend physical delivery. They'll cite logistical bottlenecks or market irregularities. Invoke force majeure. Tell people waiting for metal they're sorry, can't give bars, but here's cash equivalent. Settlement at 71. Forced paper currency. This is the moment of default. Won't be called that on CNN. They'll call it settlement procedure. But to anyone who understands money, it's default. And while you're holding $71 cash settlement, the real price of silver in physical markets will be gapping to 150. You'll be priced out forever, holding depreciating fiat while the asset leaves the solar system. This is why inventory data matters. 38 million is the countdown clock. Every million that leaves brings us one day closer to cash settlement. So what's the path forward? I need to shatter a dangerous illusion. There's a fantasy on social media that because inventory is low and shorts are trapped, we'll see vertical explosion. Wake up Monday, silver at 100. Straight line up. I'm telling you that's not happening. The path to triple digits in 2026 is a grind. A dirty, volatile, exhausting war of attrition designed to strip you of position before the finish line. The banks have lost control of direction. Supply shock and inventory drain mean price must go up. But they still control speed. They own the casino, set margin requirements, control algorithms. They'll use that to make the rise from 71 to 100 take as long as possible, inflicting maximum pain on leveraged speculators. Their first weapon is volatility. Days where silver rallies $5 in morning, crashes 7 in afternoon. Flash crashes to trigger stop losses. They'll smash from 75 to 68 in 10 minutes to wipe out longs, then float back to 75, running the stops, generating liquidity, forcing you to sell at a loss so they can cover shorts. If you're holding paper contracts, you're picking up pennies on a highway. You'll get run over. Second weapon is margin hikes. We've seen this start. COMEX quietly raised margin requirements twice last month. They'll do it again. At $80, they'll double margin. At $90, maybe triple it. They'll say it's for market stability. Real reason is pricing out the little guy. If it costs $10,000 to hold a contract, retail can afford it. Raise it to $50,000 overnight, retail gets margin call. Doesn't have cash. Has to sell. Who has cash? The banks. So what does the roadmap look like? I believe we're entering stair-step repricing. Won't go straight to 100. We'll grind to 80, chop sideways 3 months. Boring. Frustrating. News will say rally's over. This boredom phase is designed to make you lose interest. Make you sell and buy NVIDIA instead. Then once weak hands are gone, gap to 90 overnight. Then crash, then grind. Mechanism of exhaustion. But while paper plays games, physical reality tightens. That 38 million will tick down. 35, 30, 25. Divergence between paper volatility and physical depletion widens until the rubber band snaps. The target is 100. No doubt we see triple digits in 2026. Structural deficit from China ban is 200 million ounces annually. Investment demand adds another 100 million. Mine supply is flat. The math is undeniable. We need a price that destroys demand. 71 doesn't do that. 150 might. So here's your battle plan. First, ignore volatility. Banks will smash paper price. Create flash crashes. Don't look at spot as measure of wealth. Look at ounces you own. Ounces are the scorecard. Second, buy the dips in physical market. When they smash spot to 68, don't panic. Go to your dealer and buy more. Use their manipulation to lower cost basis. Third, watch registered inventory like a hawk. That's the countdown clock. Below 30 million, we're in endgame. And this is critical. Do not buy paper. Don't buy SLV. Don't buy unallocated accounts. Don't buy futures. If you don't hold it, you don't own it. Unallocated means you're an unsecured creditor. When squeeze happens, they'll settle in cash. Give you $71 while real silver trades triple digits. You'll have missed the entire point. The only way to win is take possession. Hold the bar in your safe. Remove all counterparty risk. JP Morgan can go bankrupt. COMEX can shut down. China can ban exports. Doesn't matter. The bar in your hand is still silver. Immune to their rules, immune to their failures. The premium you pay on physical is the price of freedom from the banking system. And right now, while banks spend billions holding paper price at 71, they're accidentally subsidizing your purchase. You're buying at 79 total cost while Japan pays 130. You're arbitraging their fraud, stealing value from a system trying to deceive you. Every ounce at 79 is theft from a dying regime, but this only works while manipulation lasts. Once COMEX breaks, once registered hits zero and they declare force majeure, spot price disappears. Discount window slams shut. Price in New York matches Tokyo. You want to be the person who bought at 79, not the one paying 130. The numbers don't lie. We are watching the end of a 40-year suppression cycle. These cycles don't end quietly. They end with noise, confusion, violence. Banks will kick and scream, break rules, change margins. But they cannot print silver. As long as vaults drain, destination is locked. Only variable is the path. So tighten your seatbelt. Don't use leverage. Don't try outsmarting algorithms. Just hold the asset. Because when dust settles, when banks finish switching sides, price goes to a place where current charts don't even have numbers.